Good morning. Welcome to the big picture secular bull market update that I do a couple of times a year. I haven't done one since December last year, so some 8 and a bit months in the making for this one. And I thought I'd let the markets go a bit more, particularly or especially after what they did earlier in the month, and just see how that resolved itself before I did this analysis. And well, let's get into it. Before we do get into it, I have to tell you that everything we cover here today is general investment advice. There's no specific or personal investment advice that we are covering here today. And you should, as always, there's no past performance is not a true indicator of future performance. Right into it. So why do I do this? Why do I do the secular market update? And if it's the first time you've seen one of these, welcome, and this might be new to you. Hopefully it is, and it challenges your perspective of long-term market cycles. And those of you who are watching it again, well, we're going to do an update and just see how these longer-term valuation and technical indicators and analysis has played out over the last 8 or so months. And I've been doing this, I should tell you all, this session, if you like, since 2017, but been writing about this since the beginning of 2013, and you'll see why that date is important in a moment if you don't already know or haven't attended one of these sessions before. But what we're doing here is big picture analysis. We're stepping back and getting a big picture view, bird's eye view, if you like, of where the equity markets have been and where they're placed right now relative to their history. And this is long-term cycle analysis, and particularly using technical analysis of prices. I've already told you in the ASIC disclaimer, regulatory disclaimer, that past performance is not a reliable indicator of future performance, but cycles and trends undeniably exist. What people spend their whole life trying to do is work out why and how, and overdo it, if you like, on the analysis side of things. And we've got to try and simplify that, because really things that are simple live, and things that are overcomplicated, die. They disappear. So we want to try and keep this simple as well, and look at these big picture cycles and trends. And what surprises us all the time is how much longer they persist than we believe, and how many times you hear people saying, "Gee, what the market's done is unbelievable." People have been calling for the end of this bull market since 2015. I remember when basically they said March 2015, this bull market's been going for 6 years, too long in the tooth, got to fall. And they've been doing it on the anniversary of every around about March, because the bottom of the market, and you'll see this in a moment, was March 2009. And when March comes around every year, they're basically saying this has been going too long. It's now 15 years, as you'll see today from the bottom, that trough March 2009, in the middle of a secular bear market, where we've been on this long-term trend, and people keep calling the end of it, but it persists. And we'll point out some people. I covered them in December, and I'll cover them again, because they're to prove to you that what they were saying then, because we hadn't had any analysis confirmation, if you like, that what they were saying wasn't true. Now we'll prove to you technically that what they said was untrue, and the prediction hasn't come true. Right, so the big question we're trying to answer today is the secular trend still up? Is the secular bull market still intact? And we're looking at ultra long term, but we also will be looking at signs, early signs if we can, early warning signs if we can, to see if potentially a secular bear market is imminent. So why is this big picture analysis so important for every investor? And this is new material I haven't covered before, and really comes from the course that I did in November last year, and can see a typo there immediately. And really the psychology, the belief systems that we have with everything in life, but particularly with the market, and that is that context and perspective play a major role in what you believe to be true in everything in life. And no matter what you think, you may think, or you might dispute, if you're listening to this, is that you do have a big picture context and perspective on the market right now. And whatever that is, it will play a major role in what you believe to be true about stock markets in general, and the stock market and its direction, and it will play out into everything, every decision that you make in the market. So how does it affect, how does this perspective, spelled correctly, affect you? Is it affects everything to do with what you perceive about the stock market, what you think, analyze, and decide. And all of those will come from this perspective you have and your beliefs about the stock market. And without a skilled trading mindset, perspective will make you inconsistent unless you know how to put that perspective into context and how to use it and not use it in your day-to-day decision making in the stock market. Unless you know how to do that with a skilled mindset, you will be inconsistent. And that's what we are trying to achieve. The number one thing we're trying to achieve is consistency, not only when trading and investing in the stock market, but in everything we do. Why? Because we can't be perfect. Right, getting into it. Let's start off with the analysis of the presidential election, just to take stock. This is an old chart and it only has data up to 2018, but it would not differ that much if we had to update it, maybe be a couple of decimal point differences if we updated it, but it's still handy and is relevant. So what's happened in the most recent 4 years? So 11.2, we're in year 4 of the presidential election cycle. What's happened in most recent year 4s? S&P 500 2016 and NASDAQ 9.5 and 7.5. So both were under the long-term average. And then 2020 and so far in 2024, both above the long-term average of that 11.5. What happened, this is going back to 2016 presidential. So S&P 500, there's that 9.5% growth with a dip over there. And of course, every shape looks different. This is the NASDAQ, only up 7.5, and there that dip was deeper. And there is now remember that the actual election takes place here around about early November. There was a jump there that was Trump getting in that time, and there was the market reacted positively. 2020 November was around about here, still a positive reaction, even though Biden got in. Democrats, and typically, people incorrectly think that Democrats have a negative view, a negative effect on the stock market. If you go back and research it, they're both much of a muchness. So that's 2020 S&P 500 up 16.26% with the COVID crash included in that 16.2%. And there's the NASDAQ was up 43.6% with the COVID crash in it. In 2024, where we are sitting currently to a couple of days ago data, or it might have been Friday's data, up 18.13% on the S&P 500 and up 19.1% in the NASDAQ. So both outperforming so far. So year 4, not that bad, and that's where things sit. So presidential elections, is it going to make that much difference? It will in the short term. And how much of a difference, we don't know. And in which direction, we don't know either. Right, wall of worries. I covered this section, this time of this, and just look at what are the worrying things around the world, that the doom and gloom is the henny penny, the sky's going to fall on my head. People always look to form a perspective, to look for reasons why not to do things and why things are going to be bad. And that wall of worry covers 2 wars on the go at the moment. Inflation, interest rates are still relatively high the world over, and interest rates that affect people's cost of living are up. Not only here in Australia, as it's on your news wave, on your news telecasts every single day. Politicians making a big noise about it, newspapers making a big noise about it, and that is replicated throughout the Western world. Everybody feeling it, which should affect discretionary stocks. But then you've got stocks like super retail going through the roof at the moment. And people say, well, why is that? Well, ours is not to reason why. Ours is to do or die, and we have to work out what to do. So there's been a massive addition to government debts during COVID-19, and this is going to linger on for years, maybe decades. So that wall of worry is going to hang around for a long time. The Magnificent Seven, all the time you're reading about, it's the end. These Magnificent Seven, Nvidia's gone too high, this tech stock's gone too high, that tech stock's gone too high. And if we go back and look at the 1995 to 2000, that last 5 years, of that secular bull market, the large cap stocks, and particularly tech stocks and pharmaceutical stocks, went through the roof, and all the time they were being called as the end of the cycle. That they've gone too far. And this is what happens is you get into euphoria in both directions, negative, and euphoria is typically thought of in the positive sense, where things go through the roof, and on the other side, extreme fear, things go too far, go down too far for too long, and the same thing happens on the upside. So we'll talk a little bit about euphoria today as well, uncertainty of the US presidential election, and there's talk about secular market cycles getting shorter, even primary bull and bear market cycles getting shorter. Why? Because of communication. There's so much information getting sent around so quickly that people's reactionary times are getting shorter and shorter and shorter. But on the other side, on the flip side of that, is that so are innovation cycles getting shorter and shorter, which means new technology and new innovations are coming to the fore at a more rapid rate as well, meaning that we can actually, from a positive perspective, this could extend the cycles as well, because new innovations coming out, companies making new profit, fads starting up, meme stocks going, all this sort of stuff can extend bull market cycles as well. So there's two conflicting things. So whatever anybody comes up with from to if you like, from a negative notion perspective, if you look long and hard and you have an objective, or not even long and hard, you actually look just pretty short and simple. With an open mind and an objective mind, you'll find a countering positive notion as well. And what we don't want to do is side with one or the other and just get extremely invested in the one side of positivity or one side of negativity. We want to be neutral and to operate out of a neutral mindset, and to, if you like, give both sides equal weighting, and then to make decisions in that kind of environment. So what is this session about today? This session is about to try and be as objective as we can about looking at the positives and the negatives, and to say that the wall of worry will always be there. It will never go. We do not have a negative free world in the same way as we don't have a positive free world. We don't have a risk free world in the same way as we don't have all upside free world as well. Both sides exist all the time, and it's our job as investors to create and to continue to have a neutral mindset and to be objective in the moment with all our decisions. So the repeated wall of worry, I'm just remembering it. Let's look at some commentary. And those of you that might remember from December, I'm repeating 3 or 4 of these, and there's a new one I've added to it as well. But the noise was getting so loud, and I'll qualify why I've used the word was here in a moment. But Dr. Doom, Nouriel Roubini, he's been talking about the great stagflationary debt crisis for some time, and it'll eventually come true. It will, and it will have an effect, but we don't know when that's going to be. Harry Dent in November 2021 said that the market will be in an 80% decline from that time on, and we'll put a position on this in a moment in a chart. And Stan Druckenmiller, famous for the pound, I think it was the pound dollar, going against the pound dollar, and made $1 billion or something. He's saying stocks will be flat for 10 years, and he made that commentary in February of 2022. And Dan Ferris he's been talking about a sideways market for decades, like Japan, which basically went on for nearly 40 years. It did go on for 40 years. Is that right? No, 30 years. 34 years. And he's talking about that happening in developed markets the world over, many decades of sideways movement. This is a new one I've added, Jeremy Grantham. He predicts more doom and gloom, and this was made in January 27th, 2023. Legendary British investor Jeremy Grantham is predicting hard times ahead as he lays out his case for doom and gloom to cast a shadow on the markets. Grantham believes that a further drop of 20% is possible this year, and his worst case scenario says that the S&P 500 could collapse as much as 50% from current levels. That was in just in January 2023. And but what's happened? This is why I said is new index all-time highs have silenced them all. And when the market is going up, these people tend to get quiet, and that's just for the time being, because they'll be back. So what's happened since November 2021 is the S&P 500 is up nearly 20% since, in fact, with the overnight movement, today's session in the US, it is probably up more than 20%. That's including the 24% decline in 2022. Since February 2022, S&P 500 up 22.8 with that decline of 24%. And with a new all-time high, sideways for decades, has already been invalidated. And I think he made that call in 2022 when the market was falling. So that's already invalidated. Now, that's not to say that the market might not, and I'll show you some charts in a moment, that prices might not fall back into the range. But the higher this market goes, the lower the probability becomes of that happening. And Jeremy Grantham, since the 27th of January 2023, the S&P 500 is up 38.4%, and the NASDAQ composite is up 53.8% since then, which is, well, people could say what his prediction is still going to come true at some stage, but the fall from current levels from where he said it would go down another 20 to 50%, it's a long, long way from there. And the market can crash and it could happen. But what's happened is people who listened to that at that time and went into their shells, well, they would still be sitting waiting for this and would have missed this opportunity, which has been going for some 18 months now. There's the 53.8% of that's when Grantham called it back there in January of 2023. That's what the NASDAQ has done since then. Now, I put this in front of you just to show how bad noise is and why do people listen to noise? They listen to noise because they have a vacuum of a decision-making process in which they trust. If you have a decision-making process in which you trust, and you trust the market, and you trust yourself to be able to execute in the market with your decision-making process, well, then you wouldn't listen to this noise. You would know what to do, and then you would do what you know, rather than outsourcing to somebody who makes a one-off comment that somebody writes up in a newspaper. Noise is bad for your investment results and decision-making. So how does noise affect unskilled traders? Well, what happens is people wear most of a market decline, particularly those that are not timing or those that are buy and hold, and then they get to an extreme position where the markets are down 20%. They've experienced the drawdown in their portfolios, and then they go, well, this is too much pain for me, I'm out of here. And then they don't re-engage when the market starts rising. Big, big mistake. Why? Because they don't trust. They don't trust themselves, they don't trust their edge, and they don't trust the market. And they react to subjective noise instead of process it. And why? Because they lack these major traits. They lack acceptance, objectivity, trust, confidence, and hence they do not become consistent. So whatever perspective you have of the market right now, regardless of what I'm just about to show you, you have to get your frame of mind into one of trust and confidence. And you can't trust and then be confident unless you're objective and you accept a whole bunch of things about the environment in which you are operating. So what happens? Their portfolios remain in drawdown. And their emotional response to the market taking off because they listen to the noise and they are now uninvested and the market goes up and they broke process or they didn't believe or whatever, is that they are disappointed, they blame, they look for greener pastures, they blame themselves, they blame their process, their system, they blame the market, and they get angry. And of course, all they do is remain inconsistent because they haven't stepped into a process where they learn acceptance, objectivity, trust, to become confidence, to be able to act and make decisions on a consistent basis. So let's get into what we are going to cover today. So that's the whys and wherefores of why we cover this. Terminology for those that are new: secular bull bear market, long-term cycles, approximately 17 to 18 years is what people have, and you can go and read up on this and other technical analysis books. I'm not going to go into the whys or wherefores why I talk about 17, 18-year cycles here, but you'll see in a moment from the charts that it kind of plays out along those lines. A primary bull or bear market is a greater than 20% rise. This is technically speaking, this is the definition that people have put on it, and a bear, a less than 20% fall. And from a timing perspective, these typically happen in 1/2 to 2 year cycles, and people also call them cyclical bull and bear markets. And then you get secondary bull and bear markets within primary bull and bear markets. So that's another layer down. And then you can go intraday into even smaller cycles as well. So what this is about is really the wall of worry versus the secular market cycle. So the secular market cycle, which I'm going to put to you now, is based on price action and historical objective movement in prices and how the psychology plays out versus the wall of worry and all the negativity and the noise and everything that surrounds the market all the time, and how these two clash all the time. And as investors, long-term investors, because nobody should invest for 2 years or even 20 years, you should be investing, if you look at lifetime of investing, for 50, 60 years. And that's that big picture that we want to get. So there's this continuous short-term wall of worry, commentary, negativity that will always be there versus being objective, and that's all subjective and noise versus the historic price movement, which is you can be far more objective about. So let's set the scene. I've updated these now I think they go to last Friday. This is a monthly chart. This is a daily chart that played out over all those years. We're now up to 94 years and starts in 1930. And there we have the secular bear markets. I'm not going to go through these in too much detail. Those of you who haven't seen this before can pause and look at this. But you have primary bear markets within secular bear markets. So the secular bear markets are these long-term 13.8, and then you have primary bear markets within those, which are the falls, and then you have primary bull markets that happen as well, the rise in the sideways moving market. And that's giving you a time frame and a depth on these primary bear markets within secular bear markets. And then you can see we've got a breakout at the top right hand side over here, which I'll show in a moment. Then you have secular bull markets. Secular bull market starts from the breakout, not from down here. It starts from the breakout. That's when it's confirmed, and then it peaks over there. Now we only know where the peak of a secular bull market is with hairy hindsight. So these are these are the secular bull markets. Look, notice the years and the percent rises, and we are currently in one now that's been going 11.3 years. And it's up 257% since the breakout there in April 2013, which is why I started writing about this before that breakout, around about February of 2013, saying this may happen. If it did, it was going to be historic, and it's turned out to be historic. So looking at this secular analysis, how long could this bull market continue? Well, the shortest secular market, bull and bear, is 13.1 years. So the shortest could be, if this secular bull market turns out to be as long as the shortest secular market, that being a bear, then we could have 1.8 years to go if it replicates the shortest of the secular markets that we have, bull and bear. Or it could go another 7 years. So how am I getting that? I'm getting to 11.3 onto 18.3 there. And so that is the window. Is it exactly going to be the window? No, we're just looking for probabilities here based on a very small sample of 3 previous secular bulls and bears and 2 previous secular bulls. So that is a window, not a prediction, just probabilities as to how this could play out. Now let's go and have a look and see where previous secular bull markets were after 11.3 years. So at 257, that one was up 354% from the breakout there in 82 to that point there. Still had that much to go. And the secular bull market here was up 259%, roughly the same as that after 11.3 years. And unbeknown at the time, but we were starting to head into here. Now, why are there differences? Well, that'll become clear in a moment. So now we could also look at, as what a lot of people measure the bull market is, rather than taking it from the breakout out of the secular bear into the bull, is a lot of people measure it from the trough of the last primary bear market, which was there. So let's have a look at that. That's 15.5 years in the making, because now we're including that primary bull market there within the secular bear market before it became a secular bull market. Now we had primary bear markets within secular bull markets. The most recent one, I'm just calling it in my terms, inflation bear or high cost of living bear, whatever you want to call it. But there was a minus 25% fall, minus 25.4% fall in 282 days. That's trading days. We had the COVID crash 33.9% in 33 days. Now, let's go and have a look at that rise there. So from that trough, that last trough, at the end of that primary bear, a primary bull started within a secular bear breakout over there, 25.5 years, 2,353%, and the major primary bear market within that, and there was another smaller one over there of just under 20%, was 33.5%, which is the 1987 crash. And then we have that bull market running from that last trough up to there, which is 26.7 years and a 1,300% rise. And that where the big bear market, primary bear market within that secular bull market was the 28% Kennedy slide, they called it. So now let's do some secular analysis based on this, where we're looking from the last trough, 10 to 11 years remaining. How do I get that? 25.5 minus 15.5, 10, and that one is, say, 11.2 years still to go. So which ones are going to be? I don't know, but nor do I need to know. If I have an appropriate plan set up on how I engage the market, I don't need to know that. This is just background information, giving you a perspective. And if you like, a perspective to with some optimism, because we need to plan for the worst, but we need to be optimistic about the future in which the environment in which we operate. Why? Because if you're a pessimist, you've got Buckley's chance of becoming confident in yourself, in your edge, and in the market to be able to execute. You might as well give up the game. So we need to create this perspective that is conducive to us being successful in the environment in which we're operating, and this is it. Now, just to look at the primary bull that are coming out, and this explains why there's a bit of a difference between the secular analysis looking at the secular bears and the secular analysis looking forward coming out of the secular bulls, is how long this last primary bull market was coming out of the secular bear. This one was 8 years, 154%. That was nearly 8 years, 88%. And this one over here was only 4.1 years with 135% rise. So this was a much quicker rise out of here. And that's what's giving us the big, if you like, range, if we're looking at the analysis going forward and taking it from secular bear compared to secular bull, is because of how quickly this came out. So that's a case for saying, oh, well, gee, look at, the secular cycles are getting compacted because of whatever. People will find reasons and whys. But then, you have to look at the flip side, as I said earlier. Maybe innovation can extend these things, and maybe innovation is making these things, last longer as well. So that's the secular analysis that we're looking at. This big picture is a picture that I think we should all keep in the back of our minds. And when we've had these bear markets over here, look at these troughs, 1, 2, 3 troughs. It could even say 4 troughs. It's been henny penny, sky's going to fall on our head, the game's up. And what's happened is we've gone to new highs, and we'll zoom in a moment to get to look at the most recent price action and breakouts to new highs at the moment. A lot of people talk about the Schiller S&P 500, inflation adjusted S&P 500. So this is just showing that this lags. So this is Schiller came up with this in his book that he wrote, whatever it was, Exuberance. And he's a professor, and this is where the technical secular bull market breakouts occurred on the charts I've just shown you, compared to the inflation adjusted S&P 500. So it's certainly up here as well in new all-time high territory as well, confirming just the cash price, the cash indices as well. Right, let's have a look at some market valuation ratios. First one you're going to look at is the Buffett ratio, the S&P 500 to GDP ratio, and that is up here at new all-time highs. This is 23rd of August, that's Friday, and you can see the source where I get this from, and there are the secular bear market shown and the secular bull markets. And guess what? This GDP, this S&P 500, the Buffett ratio rises during secular bulls and falls during secular bears. No surprises there, but a couple of things to notice here, and this, if you just look at the line chart and you don't pick this stuff up, is the relative starting position of the secular bulls. And you can see this is, so people are going, if you just look at this with the naked eye, well, first of all, if you left out prior to 1950 or 1940, you wouldn't know that it's been as high as that in the past. and that was leading into the 1929 crash, obviously. So there is historic precedence that this can go higher. But of course, totally different era, time, market availability, accessibility, all sorts of things. So very difficult to compare it to them. But just from the record, if you hear somebody say it's at an all-time high, unprecedented, here's your if you like, your proof that it's not unprecedented. But the relative starting points over here, sure, 2000 to 2013, two big primary bear markets, big drop, index halved and started at a higher relative point than it did over here. So it just makes sense that this can run higher before we get into secular bear market territory. So no signs there yet of a turnaround. We'd be looking for this to start happening, and people might go, wow, look at that. That was the start of it. And it's gone. It's been negated now. It's been invalidated because we made a new high. Right, looking at the S&P 500 PE ratio, going back to the 1800s, there's the rule of 20 people talk about, and we're well above the rule of 20, secular bears and secular bulls. You can stop and analyze this yourself. You can go to that website and you can pull this apart and you can do whatever you like. But this is just showing that PE ratios have been, the market has sustained higher PE ratios basically for 30 years. So does that mean that the rule of 20 still applies? I don't know. But we certainly had tech stocks, et cetera, that large stocks continue to put up 100, 200, 300, 400% growth in their share prices, when their PE ratios are running at multiple tens, even into the hundreds. So does that mean that the market's going to fall in a heap? Well, maybe at some stage, but it is that is the data we're going to look at, and again, we shouldn't just look at one piece of data and say therefore this is going to happen. Because the moment we get a notion in our head, a perspective in our head that that we put a lot of belief in, our belief system becomes hooked on that, then we're no longer neutral. We become, our belief system gets affected by that. Our perspective affects our belief system, which then affects our perceptions, our decision making, and what we believe our worldview to be of the stock market. And that is not being consistent. That's not being objective, and it's certainly not going to breed confidence, a level of confidence you to be able to execute properly, to be able to trade properly when you are your own self creating negative views that create lack of confidence and lack of trust. Why do that? We've got to look for a way that we can engage this market where we do trust and we are confident, and then we can get outcomes. If we're beating ourselves up all the time, then what chance have we got of being successful? Right, the Shiller PE ratio, the cyclically adjusted PE ratio, again, it's a Shiller construct, and all he's done is put a 10-month moving average over it. And you can see that this, obviously, because it's a 10-month moving average, doesn't go as high as the previous chart, but nothing really to write home about here. It tells you much the same. And what we're looking for, and when we do get into a secular bear market, this is why it's difficult to be able to know exactly when that change happens. We're only going to know with the benefit of hindsight, but we are going to get something like this happening. And so this is not going to really, none of these market valuation ratios or indications or indicators, if you like, which are based on fundamental data, are really going to give you a timely view. But what will play out, I'm sure, is that we're going to get into that type of movement when we are in a secular bear market, and that's not bearing it out at the moment. Looking at long-term interest rates, you can see that there hasn't been a consistency in a secular bear market falling, secular bear market interest rates rising, and then in a secular bull market interest rates falling, and in a secular bear market interest rates falling. So I know people put a lot of emphasis on interest rates as a way of looking at market direction, but there are inconsistencies here. Right. So on just a quote that I use, so that's the market valuation ratios just looked at. So nothing really to that's giving us any indication that there is an early sign for a secular bear market just around the corner, but certainly is confirming that we are in a secular bull market. And whilst the trend is in place, we got to go with the trend on those market valuation indicators at the moment. And what people start doing is saying, well, they're too high, therefore the market's overvalued. Well, the market can stay overvalued or undervalued for a lot longer periods than what we believe they should be. And that is why we've got to be objective and look at the price action, because that's really what the sum total of the perceptions and the psychology is of the market. We've got to go with what the herd are going, but we've got to react to the herd in a timely sense so that we can achieve our goals, our investing goals. I always put this quote up. It's a fantastic quote. Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria. Okay, I've been saying this for a number of years now, is that I certainly don't feel euphoria. I don't feel the euphoria of the last 2 to 5 years, particularly the last 2 years, even the last 18 months of 1998 and 1999 and into 2000, and even don't even feel the euphoria of the primary bull markets that occurred in the secular bear market in those times, from 2003 to 2007, and even the one that occurred that took us out of the secular bear market from March 2009. I don't feel that euphoria at all at the moment, despite where the indices are. There's still skepticism, and you could find lots of pockets of that. You could also find some optimism as well. And so looking at this quote on what the late Sir John Templeton gave us is that we are somewhere between skepticism and optimism, and flicking between the two depending on whether we're in a primary bull or bear market in the secular bull market at the moment. But we are certainly not euphoric. Euphoric will be, you'll know when it happens. And what are the signs of that from the market? Vertical markets just putting on massive amounts, on a daily basis. Shallow retracements, and then more big quick rises. What do we hear in the community? Well, every person and their dog is in the market. People who are typically not in the market, getting into the market, that's when you get euphoric. And we're certainly not feeling that at the moment. In fact, what I'm feeling are people that are typically in the market, not in the market. And they are still sitting around in their hands waiting for the market. And they're basically getting in when the market, the unskilled active investors, if you like, are sitting on the sidelines during these primary during these primary bull markets, and then engaging just in time for the primary bear market. And that's because, and there are people that are typically in the market that are just getting it really wrong because of all the mixed messages and listening to the noise. So euphoria, I don't feel it. If you have got any signs that you think there's lots of euphoria around, let me know. And in fact, that's one way of us knowing. We'll all start noticing it when it happens, when friends that you have and people that you don't know are all talking about the market. If you think that is happening, then start letting me know. Right, analyzing the secular cycle. Let's just have a look at this. It's easy to, so we're going to go into a bit more short term now. Easy to determine the start of a secular bull, difficult to determine the end of a secular bull, and hence the start of a secular bear market. So we're looking now for objective signs to potentially alert to the end. So we've got the big picture. Now we're just going to zoom in a bit the last few years and see if we can pick any signs. So one of the technical indicators that I started going to a couple of years ago is the S&P 500 14-month RSI. And those of you that have done this before, I've gone through this. You can see we've got a bottom indicator. This is the relative strength index. This is an indicator. Wells Wilder, I think I've got his book over here. You can see he invented this back in the 70s. And you can see the secular bear markets, the RSI fell below, I think I've got it set at about 30 here, which is the typical setting. All secular bear market, and there was an early warning there of that secular bear coming. You only really got this warning in the first primary bear of this secular bear over here. So that was an early enough warning, confirmed over there. And now where are we at the moment? Well, we even with these primary bear markets we've had recently, did not take the indicator below the third. It's around about, I think I've got that at third, you can see about 35. So it's actually quite high, much higher than what you typically have for an RSI. Typically it's 30-70. And the top end over here, we don't really give much credence to. On the Dow Jones, confirmed this indicator as a long-term indication of it's a monthly indicator of potential signs of an imminent secular bear market plays out on the Dow Jones as well. Any signs here recently? No. It also plays out on the NASDAQ composite as well. So it works on all the three main indices in the United States. And even with this, whatever it had, I think it had a 35% retracement. In this 2022 retracement here on the Nasdaq Composite, still didn't take it below. So this indicator is certainly showing that the secular bull market is still intact, and no signs of early warning signs yet of a secular bear market. Coppock indicator, also a 14-month setting, shows that's the secular bear market on the S&P 500 in from 2000 to 2013, and indicated that quite nicely. And at the moment, and this last retracement, it did, so it's a bit more early, a bit more sensitive than the 14-month RSI, but now we're up and out on that on the Coppock as well. So that early warning all on its own is not something that you should react to. Looking at some support and resistance, and this is the most telling difference, if you like, from the session I did back in December, is we've got the S&P 500, and last time we looked in December, I think we were somewhere over here. The breakout had not occurred yet, and we had the 22, that's that retracement there was minus 25.4%, but a new all-time high has been completed in the S&P 500. Right. Harry Dent prediction of an 80% decline happened in November 2021 before that peak. So the 80% decline from there would have been whatever, all the way down here. And if you take where that 80% decline should have got to, it's a massive gap between where we are at the moment. So, and Stan Druckenmiller, his flat for 10 years, February 22 was this retracement over here. And the 10 years, well, technically speaking, his prediction has been proven false so far. Of course, there's no guarantee that the price action will just fall back into here, and then that would revalidate his prediction. But we've already gone 2.5 years of his 10-year period, and we are up over here. So far, his prediction is invalidated, and the probabilities would be on the side of it continuing to be invalidated. Jeremy Grantham prediction of a further 20 to 50% decline was made over here. And so from there, where the market was, even though it had come off its lows, it was still down about 18 or 20%. So he was talking about another 40 to 70% decline from those levels there, around about 3,800. So that would have taken us all the way down to somewhere over here. Predicting is, I don't know why these people do it. I really do not. But it just shows even the world's biggest names, most high profile traders and investors. Druckenmiller was a trader. And I think Dent's a trader, and Jeremy Grantham's probably more longer term. Massive high profile people get sucked into predicting. I just don't know why they do it. And and then they make these. This is the noise that we have got to overcome. We cannot listen to this noise. And if we are listening to the degree to which we listen to the noise is the degree to which we do not trust the market, our decision-making support systems, which are our methodologies and our edges and our decision-making tools. That's the degree to which we don't trust them, and it's the degree to which we don't trust ourselves to be able to execute in this environment with the edge that we have. And one of the biggest and first signs that you are becoming a skilled and active investor or a skilled trader is that you can ignore the noise, and that you don't go off and start making decisions and becoming subjective with your decision-making process in light of the noise that you hear. So the more you find yourself reacting to the noise, it's the biggest sign as to how you are not there as a skilled trader or investor yet. Skilled traders and investors just shut down the noise. They do not listen to it. Why? Because they trust in their current process. And I'm just really trying to show you how wrong the noise gets it. So you've got to, and hopefully that's made an impression on you today. Right, let's look at another index, the Dow Jones Industrial Average breakout. There, so this sideways now is now broken out, if you like. So the retracement's complete, and we're into new all-time highs, and there's some resistance levels there as well. The Nasdaq breakout, retest, classic retest, and quite a steep retest. The retest and off we go again. And the NASDAQ 100 breakout, look at that. That didn't quite get down to the previous high. And we just have these higher highs and higher lows. Still haven't made a higher high yet. But this is on the way out, if you like. And we still need to. Every swing up, we need to be making higher highs and higher lows to continue from an analysis, support and resistance analysis, from a price action analysis point of view. These higher highs and higher lows need to continue, and the more they do, the higher the probability becomes that this is going to go on for longer and look like, resemble, if you like. It's not going to be perfect, that, but it's going to rhyme, as the people talk about, the two previous secular bull markets that I just showed you before. And as I've been doing these sessions now for the last 7.5 years, these, and you can go back and look at the ones that I did back then. I think they're on YouTube. And you'll see when I did the analysis then how the messages continued. And it's been hard in the moment, difficult in the moment for people to believe that the secular bull market can continue. And yet it has, against all of the noise that's been calling its downfall for now 9 years. They've been calling its downfall. March 2015 is the last time. That was the first time that I remember people really, big name commentators, really calling the downfall of the secular bull market. And in my analysis, it was only really 2 years into it, nearly 2 years. It was a month shy of 2 years into the secular bull market, and people were calling the end of it. Why? Because they were taking the analysis back to March 2009 and saying we've been going for 6 years, penny, the sky's going to fall on our head. This stuff works. It really does. And if I'm challenging your perspective of the markets for the first time, repeat looking at this stuff and go and do your own analysis, go and do your own research, and it'll confirm what I'm showing you. German NASDAQ, DAX breakout confirmed as well, and a 26.3% retracement. They're all roughly there. The two NASDAQs were into the 30s, but the other major indices that were, broad indices, not tech indices, were in the mid-20s% retracements. So that new all-time high completed confirms that retracement is being complete. We're now looking for other retracements. So where to from here? So thresholds to be vigilant about as we go, because I'm probably only going to do this session again sometime next year in February, March, April. And you can continue to do your own analysis. Our existing members can find all of these analysis charts by downloading this analysis into their instance of Beyond Charts. And you can continue analysis and update it as we go. And you don't really need to do it, once a month or every couple of months. This is not, short term, keeping an eye on it every day. This is long term stuff. You can look at the 14-month RSI. So that's what I'm going to say. You want to look at the retesting and falling below the all-time highs. So those charts I've just shown you. What we're looking for here is the price action to stay above the previous all-time high, that black zone, that black support, which has now become a support zone. We want the price action to stay above that at the very least, but also want the price action to be making new swing highs. And I use a 3-day swing chart, which I didn't put on there, so I didn't clutter the chart, but my existing members have seen me use that many times. You want support levels of the S&P 500, so watch them, as I've just said, the 3-day swings and those higher highs and higher lows. And also don't get put off, in the secular bull market, if we have 20 to 35% declines. The 35 really applies more to the S&P 500 at a 33% retracement. And during COVID, as it did back in 1987, during that big secular bull market, it had a 35% retracement then. These can happen in secular bull markets. It doesn't necessarily mean the end. But if we start getting to 40% and worse retracements, then the probability starts getting stacked as that to potentially being the start of a secular bear market. And then it becomes a higher probability that it'll go beyond, like it did with the in the NASDAQ 100, had an 82% retracement in the 2000 to 2002 primary bear market, and that was obviously the start of the secular bear market that went on for in the case of the NASDAQ indices, 16 years. So on the S&P 500 went 13.1 years. In the two NASDAQ indices, that primary bear, that secular bear market went for 16 years, so closer to the 17, 18-year cycle. And keep an eye on the 14-month RSI. Now, each bar only gets plotted once a month. So you don't need to look at it that often to see. But and also it's not worth looking at the 14-month RSI unless we were in a retracement. So again, 6 months time looking at the 40-month RSI is ample time. You don't need to be doing this often. And keep an eye out for human emotion. On the positive side, extreme positive human emotion, euphoria. And I don't believe we've felt that in equities and stocks since, certainly not since 1998, 1999 and into 2000. And then certainly not in this entire secular bull market so far. So nobody can predict the future. I hope they've shown you that. And people continue to predict because they want to protect, because they fear, or they try to prove, and then they distrust and they fear, and all of this is ego. Predict, protect, and prove, and also try to please. Those are the 4 big traits of ego. That's what ego does to us all the time. And as successful as investors, these people, these big names that I put out there, they are operating out of ego for some reason. They're trying to prove something, and they do that through trying to predict and say, "Hey, I was right," and they eventually will be right. But in the meantime, they can stay wrong for a long time, and that can cost them and many other people lots of money. So, where to go from here? Succumb to noise. Hopefully, I've made that point. Continue changing your decision criteria. Is that a good idea? And just a point to make is that short-term volatility is the biggest killer of long-term goals. Why? Because short-term volatility takes us, if we haven't got the right mindset, the right active investing mindset, it takes us out of the game. It takes us out of the process. It gets us to distrust ourselves, our edge, and the market. And the degree to which you distrust any of those 3 is the degree to which you will lack confidence and hence never be able to become consistent. So what else? Where to from here? Prepare a plan for come what may and trust it. That's what we do. That's what we help people do, prepare those plans. And so you don't want to do on-the-fly prediction or listening to noise. This is I'll put this up every time, from Dennis Waitley, who was not a trading psychologist. He was a psychologist. Expect the best, plan for the worst, and prepare to be surprised. So expect the best. Be an optimist. And that is really what this session is about. So and hopefully this big picture perspective gives you a perspective that gets you to trust the markets, and for you then to know to plan for the worst. When is the worst? The worst is during secular bear markets. If you're a long-term investor and you buy and hold ETFs, or you buy and hold stocks, or you buy and hold balanced managed funds and whatever, and super funds or whatever, a secular bear market is going to be the worst for you, because effectively you're going to go sideways and only get dividend returns during that time. But you're also going to have to psychologically go through big, deep falls in the market, which most people can't handle. And guess what they do is they get out at the wrong time, because they don't have an investing mindset that is conducive to long-term profitability. Plan for the worst. That's the worst you plan for, secular bear markets. And prepare to be surprised by how long the market can stay very positive or very negative. So prepare for a secular bear, which is the worst. And what Dennis Waitley said, best strategies for a secular bear market are not buy and hold index ETFs, not buy and hold stocks, not balanced funds, not discretionary, intuitive, subjective, active investing, because during a secular bear market is when the risks are going to come to the fore all the time. The noise is going to be turned up massive decibels and cause you, if you don't have a skilled mindset and you are subjective and you are discretionary and you are reacting to the noise, to be highly inconsistent. Why? Because in a secular bear market, as I just said, you get no growth for 13 to 20 years, only dividends. And you also have to live through 40 to 80% declines, at least 2 of, which unless you got a mindset that has been trained to be skilled to handle those environments, you will not handle it, which means that what happens, how does that manifest itself? You sell at the bottom. The number of customers that have told us in 2008 that sold CBA after they'd been holding it for 13 years, they sold it when it was when it had fallen 60% and never got back into it again until it had gone up, more than doubled. So these are the mistakes that people make during secular bear markets. So what you got to do in a secular bear market is avoid most of each large primary bear market, And so you want to minimize exposure through objective and consistent timing. That is the big falls, the primary bear markets happen in secular bear markets. And you want to make the most of your primary bull market. So in a big sideways pattern, with long-term timing, you don't have to be a trader. With long-term timing, you can outperform the secular bear market. That's what you've got to prepare for. Now, when that starts, I don't know. Could be a year from now, or it could be 11 years from now, as I showed you with the secular analysis. So during the primary bull markets, you want to maximize exposure. You want to trust and be confident in doing that in a sea of noise and negativity. Warren Buffett quote, "In a year when the general market had a substantial advance, I would be well satisfied to match the advance of the averages." So to match the market when it's rising and to not be in it when it's falling. So starting this approach will be too late after the secular bear market starts. You have to prepare yourself and train yourself mindset-wise and edge-wise before that market arrives, not during it. It'll be too late. Why? Because it takes a few years to acquire the mindset necessary to actively invest through a secular bear market. And that's what we do. We train people to get the mindset to be able to handle a secular bear market. And if you want to get ahead, those of you who are ex-members or not currently financial with us, you can get this book from sharewellsystems.com/ebook. Our existing customers and members can get this in the Education Center. It's a book that's been out about 6 or 7 months that I wrote, and it's all about getting the right mindset, and it's about doing, which I'll mention to you in a moment, a 4-week training intensive. But get that book, sharewellsystems.com/ebook. And just to summarize now, to finish this within the hour, is that secular bull markets make new all-time highs. Secular bear markets don't. And you saw those big sideways, 3 big sideways moving markets. They didn't make, when they got to previous highs, the breakouts failed. They might have extended the range a wee bit, but they basically fail at those big turning points. Secular bull markets continue to make new all-time highs. And that is why I'm saying the probability is high that this market's going to continue from these breakouts that have occurred recently in all those major equity indices around the world. Bear markets, secular bear markets do not make new all-time highs. And therefore, I'm calling the secular bull market to still be intact. But remember, be an optimist if you like, but plan for the worst. Expect that we're going to have 10 to 35% falls during this continuation of the secular bull market. Anything can happen. So the secular bull market could end next year, which is only 4 months away, or all the way through to 2036 in the most extreme case of all the precedents that we've seen of how long previous secular bull markets have continued. You do not need to know what will happen next in order to make money in the market. That's Mark Douglas's second fundamental truth of the 5 that he put out there. Anything can happen is the first fundamental truth, and that is what you need. You need to, your trading activity, ongoing active investment activity, needs to be according to Mark Douglas's 5 fundamental truths. So be prepared with an appropriate investment plan. Start creating, if you don't have one, an investment plan that works in secular bear markets. If you've got one that works in secular bear markets, it will work in secular bull markets, and then stick to it. Trust it. Understand the big picture of long-term market cycles, which I've gone through here. So have that picture in your head. Keep that 1930 to 2024 S&P chart in your mind's eye at all times. That gives you your perspective on markets. Have a look at it every now and then. The point I made is that perspective and context, they provide an overriding background theme to your perceptions, how you think and how you decide, how you feel about the market in which the environment, which is the stock market in which you are operating. And you have to create in your head, in your psyche, in your belief system, a trust in the market. I call it the 3 trusts, the trust in the market that will lead to confidence, which means you have to accept the risks of the market. You have to be objective about analyzing the market. You have to also then trust the market, which gives you confidence in the market, which then gives you a snowball's chance of being consistent in the market. Whether you accept today's analysis or not, That's not an issue. I don't mind that, right? But believe that you will have a perspective. You will currently have a perspective. Why? Because your belief system needs one. And what you need to ask yourself is that perspective helping or harming your active investing or even your buy and hold investing? Because you will have a perspective. And if you have a negative perspective, you're going to have, which really is going to lead you to distrust the market, then you are going to battle to be successful in the market, because that's the first step. First thing you got to do is trust in the market and be confident in the whole underlying working of this thing called the stock market. Because if you don't trust the market, you're not going to be able to do the next thing, which is trust your system. And then the third trust is to trust yourself. You have to get that first trust in place first. And it has to be a confident one. So how do you take advantage of the opportunity stream of the market, this beast called the stock market, especially in secular bear markets? You have to overcome noise. You have to accept the risks of investing and trading. This is all a psychological path that you have to get onto, where you totally and utterly accept all of the risks to do with investing and trading in the market. These are the steps to consistency. I've already told you what they are. The first step is acceptance of all the risks, being objective in your analysis, then trusting the market, your system, and yourself, which then leads to confidence. You will never be able to be confident without the prerequisite of trusting. Trusting will not happen without the prerequisite of objectivity, because you can't trust something that is subjective and keeps changing all the time. And guess what? You'll never become objective unless you accept the risks, the positives as well as the negatives, with the environment in which you're operating. And only then will you ever be able to become consistent. How do you do that? Well, Mark Douglas said the only way, also trading in the zone, is to use a mechanical system. He makes it blatantly clear in his book, Trading in the Zone. And what we've done is constructed a course. And I'm saying this to our members because we still got a lot of our members who have been long-time members, or even there'll be a lot of people that are attending this that are ex-members taking a break from the market because they don't trust the market, is to do our 4-week process and mindset training intensive. It's it really, if you want to get an insight into how that's changed people, go and have a look on our website and transform the way that they view the market, the way they view the edge, and the way that they view themselves in how they engage the market. Go and have a look on our website. Go to the success stories, and there's 13 videos up there that you can have a look at of people that have shared their experiences with us. Recent videos on basically how they've done, how the process and mindset training intensive has affected their trading. That's it, the 4-week training, 4-week process and mindset training intensive. And for our existing members who haven't done it, I urge you to do it as well. It can only do you good. It cannot do you any harm, I promise you. And go to our website, sharewealthsystems.com, and have a look at the success stories page. And for those of you who want to get the book, which also talks about in quite some length as to why you need to do this course and what's entailed in the course, which is the book From Flustered to Unflappable Trading, go to sharewealthsystems.com/ebook and you will get it. Right, let's have a look at some questions we have here. Some thanks coming in. Thank you, John. Right, let's go to the bottom. Yeah, Irene, that's a good idea to have a overlay of the SS on the valuation charts. I can do the S&P 500 on that. Thank you, Don. Are these all thanks? There's no questions. Right. Of course, you don't have to ask questions here. You can ask them anytime you want, either on the forum or where the recording of this will be put up. It'll go onto YouTube, and it'll be made available to all and sundry, anybody who wants to watch it, and you can ask questions there. So I thank you for your time. It's a pleasure delivering this. It gets me to do a whole lot of analysis for myself. I need to do this myself as an active investor, and it gives me the perspective that I know I need as well as a human being to be confident and consistent in the moment. So I wish you objective and consistent and peaceful active investing.